50,000 rupees default vs 5,000 crore rupees default. Is India's banking system biased? Miss 1 ME of 10,000 rupees, and recovery calls start. Miss 3 MS. Your CIBIL drops. Legal notice arrives. But when a company defaults on 5,000 crore rupees, it gets restructuring, it gets moratorium, it gets time. Why? Is the system unfair? Or is there something deeper? Today, we investigate. Chapter 1, The Small Borrower Reality. A salaried employee takes personal loan, home loan, MSME working capital. The system tracks everything: credit score, ME delay, SMS alerts, auto recovery process. If default continues, recovery agents. SARFAESI action. Asset seizure. Legal notice. Fast, direct, mechanical. No negotiation power. Because retail lending is algorithm driven. Chapter 2. The corporate loan structure. Now imagine a 5,000 crore rupee infrastructure loan. It is not one bank. It is a consortium of 5-15 banks. There are project reports, risk committees, board approvals, external valuations. It is not automated. It is relationship-based lending. Human discretion enters. And where discretion enters, risk enters. Chapter 3. Where fraud or failure enters. Fraud doesn't begin at default. It begins at sanction stage. If project cash flow is overestimated, political pressure exists, collateral is inflated, or bribes influence approval, the loan is weak from day one. When the project fails, the exposure is massive. Chapter 4. The too big to fail argument. Banks are you. If a 5,000 crore rupee company collapses, thousands lose jobs. Suppliers collapse. Markets panic. Stock prices fall. Economy is affected. So they try restructuring. Under the Insolvency and Bankruptcy Code, corporate borrowers get moratorium protection, resolution timeline, competitive bidding, settlement options. Retail borrowers rarely get structured relief like this. Chapter 5. The NPA crisis between 2010-2018. Large corporate NPAs exploded. Public sector banks suffered the most. After regulatory tightening by Reserve Bank of India, asset quality review exposed hidden stress. Transparency improved, but perception damage remained. Chapter 6. Is it bias or structure? Let's be honest. Retail loans are smaller, diversified, easier to recover. Corporate loans are concentrated, economically sensitive, politically visible. So banks behave differently. But here is the key question. Does economic sensitivity justify unequal accountability? That is where public anger begins. Chapter 7. The real problem. The issue is not small vs big. The issue is weak due diligence, political interference, delayed judicial process, evergreening of loans, collusion in sanction stage. If sanction stage is clean, default stage is manageable. If sanction stage is corrupted, taxpayers eventually pay. In India's banking system, size doesn't just increase the loan amount. It changes the rules of engagement. But here's the truth. Not every corporate is protected. Not every banker is corrupt. Not every small borrower is helpless. The system is complex. But accountability must be equal. Because at the end of the day, it's public money. And trust is the real currency of banking. Next episode. How loan evergreening hides real NPAs. Subscribe if you want the truth without noise.